Hey, Internet. It's Ryan again with DP Marketing.Services. Hope you're doing well. Thanks for tuning in. If you're an HVAC or plumbing contractor, you probably know we work with companies just like you around the country. We work on them maximizing their lead flow. It helps them get more calls, make more customers, make more money. That's really what we do. And so, like if you think about like a balance sheet or a P&L, like we focus a lot on maximizing the revenue, right? The top line of that, of the income statement. But what we also care about is helping you maximize your bottom line, your profits. So we can make sure we drive traffic and activity and phone calls and make sure you get more leads and have your guys running and being busy in the field, making more money. But what we also want to do is make sure that you're turning the increased revenue into increased profit. So here's a simple hack. I don't know if you guys know this or know about this or thought about this. If you understand this hack, uh, it will be huge for your business. So here's how it works. So first, let's talk about flat rate pricing. Chances are you're either doing like time and materials or doing flat rate. It's one of the two. If you're not doing flat rate, so if you're doing time and materials right now, I would highly encourage you to look into flat rate. We can help you calculate it. We can help you. We actually have a step-by-step guide on our website. If you have your financials handy, you can actually walk through and determine your own cost structure for your own business. There's other companies who do that service for you. They provide you the price book. It doesn't matter. There's a ton of value in that. But here's the underlying principle in the flat rate and how it's built. It takes your annualized job hours that you do in a given year, and it distributes your overhead cost throughout each of those hours. So what this does is it takes out things like your peak season and your slow season of like summer or winter months, where things are just naturally busier because you have more customers having more issues at that time. And it makes it where all that cost and all that activity is carried over a calendar year, which means it's easier for you to keep guys on the payroll when the phones are slow because you budget that in, right? So your cost to do that's carrying that annualized. So how the flat rate pricing is built on, it's built on this idea of a break even point. So it takes your annualized hours and figures out how much cost per hour do you need to generate in revenue to offset all of your cost. Now you're not talking profit yet, not talking anything like that. All we're doing is saying uh, activity and then offsetting your cost. So here's how this works. So if you say your annualized job hours breaks down to you do, I'm just going to make up a number. Let's say you do 100 service hours per technician per month. Okay? Your company might be higher, might be lower, it just depends. But let's say you do 100 service hours per technician per month. Here's how this hack works once you understand this cost structure. As long as you book 100 hours that month for that technician, all of your costs are covered, your profit is fine, you're going to make good money, you're going to have no issues with your overhead. If you book less than 100 hours, you got some problems, right? Because now all of a sudden you're going to say, that means that we're shortcutting our taxes or our advertising budget or our staff that answers the phones. There's some cost that's getting trimmed because you didn't get the volume of work. The whole price structure works on this concept called volume. Oh gosh, what is it? Cost volume pricing. So it's the cost is based on the volume of work, and that's how you determine your pricing. Cost volume pricing. Uh, so as long as you do your 100 hours in this example, you're great, right? There's no issues. If you do less than 100 hours, it's gonna suck. Maybe you can make up for it the month before, the month after, but as long as you're doing that 100 hours a month, you're great. So here's where this comes in. As soon as you book 101 hours for that same tech in that same month, all of a sudden you have maximized your profit. Now let's walk through the math. So for 100 hours, the break-even price of your company in the flat rate model says that for every one of those 100 hours you do, you're covering your fuel cost, you're covering your vehicle like insurance, you're covering your parts, you're covering any sort of supplies. All that's covered over, right? So your storefront, your taxes at the end of the quarter, payroll expenses, all those costs that you carry are kind of averaged out over those 100 job hours. You with me? As soon as you do 101 job hours, all that cost, that overhead cost that you've had to carry, they're gone. They're paid for. There's nothing else that you have to apply that to. The rest of that fee that you collect during that 101st job hour goes only to your job cost. So any subs, any rentals, anything directly affecting the cost of that job at that time, the rest of that money goes to the bottom line. So it's what's called the contribution margin. So everything else that you book between 100 hours and 100 and a million hours is pure profit. Pure profit. All you do is take out the direct job cost and everything else flows to the bottom. So here's where this is really cool for your business. If you understand what your volume of hours is per month, you can incentivize your team to squeak out a few extra hours or a few extra calls. And even if you have to pay a little bit more in AdWords, or even if you have to do a little bit more on your customer incentives to get them to do an upgrade option versus just the initial service that they requested, all that does is fall directly to your bottom. It is far cheaper for you to maximize your profit once your overhead costs are already carried. So that's how you want to think about understanding your financials, of understanding your cost volume pricing, of what is your break-even point, what are those hours per month that you need to make sure your techs are working, and making sure that once you hit that number, if that number is 100, or if that number is 160, or if that number is 250, whatever that number is for your business, as soon as your techs hit that number, find creative incentives for them to go above that number. Every time you go above that number, even if you're paying overtime, you make more money because all of your overhead costs are already paid. That portion that's normally allocated into your rate drops right to the bottom line for profit for you. So I hope this is helpful. I'd love to know what your thoughts are. Do you guys use this now for your company? Do you find ways to incentivize your team? What does that look like? And so if you have a story, tell it here. And actually, we'd love to do some interviews with people like you. So if you're like, man, we've done exactly this, and you'd like to be set up an interview, we could talk about it. We'd love to do that. So again, subscribe to us, like us on Facebook, leave us a comment below, and check us out, DP Marketing.Services. I hope this is helpful. We'll talk soon.